Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Intuitive Machines stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a micro-cap company, 280 million market cap. They're trading at $9.59 a share, and they have 29 million shares outstanding. Intuitive Machines is a space exploration company. They started a lunar program to provide lunar surface access, lunar orbit delivery, and communications at lunar distance. They have 3 NASA contracts, and they went public via SPAC, a special purpose acquisition company. That's like a reverse merger, when a public company acquires a private company to help the private company go public. On February 22nd, the company's spacecraft, Odysseus, successfully landed on the moon. It was the first privately built craft to land on the moon, and the first American spacecraft to do so since 1972, over 50 years ago. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a small positive in 2020, but it was negative after that. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every single year. Revenue is a sales for the company, and that doubles from 2020 to 2022. However, it does go down in the trailing 12 months to 78 million. Not much revenue at this point. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 547 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $384 million. We divide that by 29 million shares. And we get a calculated stock price of $13. They're trading at $9.59, so they're trading at a 27% discount. It is a buy according to the model, but it's a really hard company to value because they don't have much revenue. They have negative free cash flow each year. So I just used their revenue growth according to the analyst estimates, and then I assumed they would have positive free cash flow by 2026. I assumed they would convert 8% of their revenue into free cash flow that year, which is the industry average. So it's really a guess at this point. Maybe they'll get a lot of money from the government, so they won't need to generate as much revenue as a regular company. They'll get a lot of funding. There are 68 companies in the same industry as LUNR, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a little more than the median in CapEx, 32 million. CapEx is the investments in property, plant, and equipment. We can't look at their debt to equity ratio since they have negative equity. They still have negative free cash flow. They rank 46th in market cap of the 68 companies. We can't look at their price to book since they have negative equity. Price to book is stock price over book value per share. Book value is equity. We can't look at their PE since they have negative earnings. PE is stock price over earnings per share. We can't look at their price to free cash flow since they have negative free cash flow. Price to free cash flow is stock price over free cash flow per share. The great thing about price to sales is you can always get a number because revenue can't be negative. It could be 0, it can't be negative. Price to sales is stock price over sales per share. And their ratio isn't too bad. It's between the median and average. They're trading at 3.6 times revenue. Huntington Ingalls is trading at 1 times revenue. That means their revenue equals their market cap. They don't generate much revenue, this company, only 78 million, and we can't look at their 5-year annual revenue growth rate. They haven't been public that long. Axon Enterprise is number 1 at 30%. Let's take a look at their most recent 10Q. This is as of 9/30/2023. We'll start with their income statement. Revenue of 12.7 million, up from 10.3 million. The only revenue breakdown they provide is between fixed price, which is 10.3 million, 81% of their revenue, and time and materials, 2.5 million, 19% of their revenue. And they explain it here. We perform work under contracts that consist of fixed price, cost reimbursable, time and materials, or a combination of the 3. Pricing for all customers is based on specific negotiations with each customer. A small portion of their revenue is from engineering services, which are time and material type contracts. Their cost of revenue for the third quarter is $26 million, which is more than their revenue. Cost of revenue is mainly direct material and labor costs, launch costs, manufacturing overhead, other personnel related expenses, which include salaries, bonuses, benefits, and SBC. And they also include freight expense. Another part of cost of revenue is the write-down of inventory when it exceeds the value on the balance sheet. We expect our cost of revenue to increase in absolute dollars in future periods as we sell more products and services. I think that goes for any company. As we grow into our capacity and execute on cost optimization strategies, we expect cost of revenue as a percentage of revenue to decrease over time. So as they scale and grow, they'll become more efficient, and cost of revenue will decline as a percent of revenue. Let's go back to the income statement. Below cost of revenue is depreciation, $300 million. General and administrative expenses, that's pretty big, $9.9 million. G&A, or some companies call it SG&A, selling general and administrative expenses, is mainly personnel related expenses for sales, marketing, supply chain, finance, legal, HR, and administrative personnel. Also, expenses of customer service, IT, professional services like legal, insurance, travel, allocated overhead and marketing, communications, and admin expenses. In the third quarter of 2022, an operating loss of $12 million. In the third quarter of 2023, an operating loss of $23 million. Their expenses are getting higher. Because their revenue went up $2.5 million, expenses went up $13.5 million. They have a gain in other, a gain of $39 million. So that gives them a net profit of $15 million for the third quarter of 2023. You should focus on operating loss or operating income, because net loss or net income has these gains or losses in other, which aren't part of the company's core business. This change in fair value of earnout liabilities, a gain of $36 million. Earnout is like equity. If the stock price goes up, then the investor earns money from the company. The company pays the earnout. But if the stock price goes down, then the liability decreases in value, which benefits the company. So they don't have to pay out to that investor. So the initial earnout was $100 million. And I think since the stock price has come down, the liability decreases, which is like a gain for the company. So for the trailing 9 months, the first 9 months of 2023, they had a gain of $61 million in earnout liabilities and a gain of $10 million in warrant liabilities. These are non-cash items because the liabilities are reduced, meaning the company doesn't have to pay out any money, so it's a gain. But these positives will be reversed out on the statement of cash flows. You see $61 million and $10 million? On the statement of cash flows, we'll go over it later in more detail, but you see negative $61 million, negative $10 million. Because you have to reverse it out. The purpose of the statement of cash flows is to convert net income into cash. If you've been watching my live streams, I've been showing you how the income statement, balance sheet, and statement of cash flows are connected. I was using an example company and going through all the steps. So this is probably pretty clear if you watched that live stream. But if you didn't watch it, I know it can be a little confusing. They have a lot of diluted shares. 26 million, 17 million non-dilutive. So if all the convertible securities convert to equity, they would have 26 million shares outstanding. That's about a 50% increase in shares. Let's look at the balance sheet. Current assets 49 million, current liabilities 100 million. That's a big problem. They're going to need some debt to get through the next 12 months. Since they have negative cash flow, they have to take on debt or dilute shareholders just to get through the next 12 months. They have 41 million of cash, 17.5 million of PP&E, and they give a breakdown of the PP&E. 1.5 million leasehold improvements, 2.2 million computers, 2.5 million machinery, 14 million construction progress. So the gross value is 21 million. They depreciated 4 million, so they have 17.5 million on the balance sheet. So their total assets 100 million, up 35 million from the end of 2022. Total liabilities, 163 million. Half their liabilities are contract liabilities, 50 million. 28 million of deferred revenue, 13 million of contract loss provision, and accrued launch costs $9 million. They have a good amount of debt for a company with negative free cash flow. $20 million of long-term debt due within 12 months. Let's look at the equity section. Assets minus liabilities equals equity. They have negative equity, which means their liabilities are higher than their assets. Let's look at a statement of cash flows. This is for the trailing 9 months. So the first section is operating cash flow. You start with your net income, which was $10 million. Then we have to add or subtract the non-cash items on the income statement. We subtract out the $71 million because they showed a gain on the income statement. That was a non-cash gain. Warrants are long-dated options issued by the company. If the stock price goes down a lot, then the warrants usually expire worthless. If the stock price goes up a lot, then the holder of the warrant converts the warrant to equity and it dilutes the shareholders. So they had a cash outflow of $23 million for the first 9 months. Last year, they had a cash outflow of $28 million. For the first 9 months of 2023, they spent $28 million of PP&E. They issued $26 million of preferred stock. They received $20 million from the issuance of securities. I'm not sure what securities these are. It looks like it was a credit facility, so $20 million of debt. They received $13 million from a forward purchase agreement termination. A forward purchase agreement is a contract between two parties. One party to sell a security to another party. So it looks like they received $13 million when this terminated, probably because the stock price went down. And they sold $16 million of warrants. So in their financing section, they had a cash inflow of $65 million. So cash at the beginning of the period, $15 million. Cash went up $26 million for the first 9 months of 2023. The way you get $26 million, it's a sum of operating cash flow, investing cash flow, and financing cash flow. So cash at the end of the period is $40.7 million. If you go back to the balance sheet, you see the $40.7 million here. It's a little different. So if you sum 4652 and 62, then you get what's on the statement of cash flows, the 4714. They mention it right here, restricted cash of $62 million. Restricted cash is cash that's set aside for a specific purpose, like to buy an asset or to buy a company. Let's take a look at the stock on Simply Wall Street. Its last price, $9.59, $948 million market cap, up 31% this week from that launch, down 60% for the year. Let's see what they say about the company. Intuitive designs, manufactures, and operates space products and services in the US. Its space systems and space infrastructure enable scientific and human exploration and utilization of lunar resources to support sustainable human presence on the moon. The company offers UNOVA, a LUNR rocket-fueled drone, lunar surface rover services, fixed lunar surface services, rideshare delivery services. I guess they have Uber on the moon. Lunar access services, lunar orbit delivery services, and lunar data network services, as well as content sales and marketing. It also offers aerospace engineering services to NASA and the aerospace industry. They were founded 11 years ago in 2013, based in Houston, Texas. This company is a SPAC, so it was private, then acquired by a shell company. So its stock price was $10, and then when they announced the acquisition, people stopped buying the stock, and it peaked at $20. That was in February 2023, 1 year ago. Then over the next year, the stock crashed and burned, getting to a low of $229 1 month ago. But like a rocket ship, no pun intended, the stock price went up, breaking through $10, its initial SPAC price, but it has come down a little bit. It's really hard to see if there's a lot of upside because as a business, I'm not sure if they're going to be profitable. It's a great concept and it's great for society to land on the moon, but I'm not exactly sure how they make money besides NASA contracts. Simply Wall Street does not value this company. 4 analysts priced this stock at $8.75. They say it's overvalued. Their 2024 revenue forecast is $270 million. 2025, $280 million. 2026, $300 million. Here's their debt since 2020. It was $1.8 million. Then in September 2022, it got to $20 million, where it is currently. And this debt is due this year, so they need to pay it off. And this blue line is their equity, which is always negative. That means their liabilities are higher than their assets. This green line is their cash, so they do have enough cash to pay down their debt, but they need more cash to pay their expenses to run their day-to-day operations. Don't fret, because even though the company is losing money, the CEO is getting paid. His salary went from $380,000 to $700,000. 39% of the company is held by the general public, 25% by insiders, 23% by hedge funds, and 14% by institutions. Armistice is their biggest shareholder at 17%. Cam Ghaffarian, the co-founder, owns 13%. Michael Blitzer, one of their board members, owns 6%. The Ivy League UPenn owns 2.4%. Geode, 0.5%. Cantor Fitzgerald, 1/3 of 1%. BlackRock, 1/5 of 1%. And Schwab, 1/10 of 1%. Their employee count is up a little bit from 142 to 160, and the ticker trades on the NASDAQ. Let's take a look at some news articles for the past few months. This was in mid-February. The price target was $6, so it blew past that. It was trading at $5.56 when this analyst increased their target to $6. Actually, it was 4 analysts. It must have been the average of those 4 analysts. And when they wrote this article, the stock was down 82% over the past year. The company unlocks new achievement, but caution is warranted. They achieved a new milestone yesterday with the launch of Nova C lander toward the moon, which is expected to land on the lunar surface by February 22nd, which it did. Nova C carries 5 NASA payloads designed to support future moon expeditions, including experiments to analyze lunar ice and radiation. There's lots of information NASA needs, and this company has the opportunity to provide NASA with that information. In a report published in 2022, NASA outlined the embracing of a commercial-oriented approach in its Artemis program. This is good news for private companies. The Artemis program is a NASA program established in 2017. The purpose of the program is to establish human presence on the moon. And the last time we had human presence on the moon was Apollo 17 in 1972. According to PwC, Price Waterhouse, the lunar transportation market is worth $55 billion by 2040. And this company is well positioned to benefit from this growth. So I guess that's how they're going to make money from bringing people to the moon and charging a fee like an airline would. On February 9th, investor sentiment improves as stock rises 33%. On January 21st, new minor risk, market cap size. The company's market cap is less than 100 million. It's 64 million. This is considered a minor risk. Companies with a small market cap are most likely businesses that have not released a product to market or are simply very small companies without a wide reach. Either way, risk is elevated with these companies because there is a chance the product may not come to fruition or the company's addressable market or demand may not be as large as expected. I think that's definitely the case with this company. In addition, if the company's size is the main factor, it is less likely to have many investors and analysts following it and scrutinizing its performance and outlook. If there's less eyes on it, there's a chance that you can take advantage of market misinformation. On January 9th, not many are piling into this stock as it plummets 25%. Stock price down 25% in the last 30 days. In the last 12 months, it's down 77%. On 12/26, the day after Christmas, the company announces CFO changes. Eric Sally is departing as CFO for personal and family reasons and to pursue other business opportunities. Stephen Vontor will serve as interim CFO during this transition. Mr. Vontor is currently the principal accounting officer. He joined the company in 2022 as the controller and has played a key role in taking the company public and building out the accounting and finance team in partnership with Mr. Sally. The company is in the process of finding a permanent CFO. Maybe they'll hire me. On December 10th, shareholders have been diluted. Increase in shares outstanding 123%. This is a major risk, often due to the company raising equity or options being converted into stock, All else being equal, if there are more shares outstanding, then each shareholder is entitled to a lower proportion of the company's earnings, thus reducing EPS. EPS is earnings per share. It's net income over total shares. Although dilution might not always result in lower EPS, for example, if the company is using the capital to fund an EPS accretive acquisition, in a lot of cases it does, along with lower dividends per share and less voting power at shareholder meetings. The following risks have been identified: negative equity, earnings are forecast to decline by 62%. A minor risk is large one-off items impacting financial results. On 11/15, third quarter 2023 earnings released, EPS 90 cents versus a loss of 10 cents in 3Q 2022. Revenue $12.7 million, net income $14.4 million. Revenue is forecast to grow 46% on average the next 3 years, compared to 7% growth for the entire aerospace industry. On 11/14, revenue estimates decreased by 23%. 2023 revenue forecast fell from $153 million to $118 million. EPS unchanged from a loss of 81 cents. Share price fell 4% to $3 over the past week. The company announces it has received $20 million in funding. We saw that on the statement of cash flows. It's a revolving facility. It's debt. On August 14th, no longer forecast to break even. 4 analysts covering the stock no longer expect the company to break even during the foreseeable future. The company was expected to profit $1.4 million in 2024. Now it looks like a loss of $7 million in 2024. So I guess that's the end. Let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.